Good morning and welcome to this Monday, November 29th, 2021 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. One second. All right, trying to battle through some of these allergies. Anyway, let me see. I might have to take a break from time to time here. All right, let's try this again. All right, so we're getting started. New week, of course, Friday, an absolute bloodbath. Woke up to some really poor futures. Things really didn't get much better throughout the day. We did hold off on selling further. So I guess that was one positive we could take away from Friday. I just think it's too early to, we really don't know anything about this new COVID-19 variant. And that's just going to make trading that much harder, I think, in the near term, because which way is this going to go? As scientists look at it, we start to figure out some things about it. Maybe it's more highly transmissible, maybe not. This last thing I read was they haven't shown any signs yet that this variant has, any worsening symptoms. Well, I got this bout all of a sudden right as the show started. I'm really sorry. Anyway, as I look at the market and try to figure out which way the market's going to go, this is really a wild card. And it makes it really difficult to try to figure out what you're going to wake up to. I mean, we went through this once back in March 2020, but we didn't have any answers back then. We had no answers. There were no vaccines. There was no knowledge really of what the heck the virus was and how we could get rid of it and how long it was going to take and the impact. And there were so many uncertainties. I do view this differently. While short term, it certainly will spook the market from time to time, I think we're in a much better situation at this point. A lot more folks are vaccinated. There's no real word yet on how well the vaccinations will do relative to this new variant. But we at least have those. It may turn out that, there was a lot more worry surrounding the Delta variant. And while it definitely was a healthcare issue, it didn't turn out to be that bad for those who were vaccinated. So, I mean, there's a lot of issues, and I don't want to get into the whole, vaccinated versus unvaccinated and all that. That's beyond the scope of what I try to do. But I'm just trying to be a realist when I look at the market and, what we have available. And I just think we're in a different position now than we were, 18, 20 months ago. So I'm not nearly as concerned with this, but that doesn't mean that the market isn't going to, I don't want to use the words take advantage, but that honestly is, I think, sometimes what happens when we start seeing a lot of these negative headlines. One thing I was encouraged about on Friday was the fact the market, after selling off at the open, for the most part, didn't sell off much more. I mean, everybody, those that were panicking and selling at the open found plenty of buyers. And that was good news in March 2020. And I believe it's going to be good news for the market as we move ahead. But it's so early to tell. As more news comes out, it's not just the reaction to the news, because if the news is bad, we're going to have a negative reaction. It's not so much that, it's what happens after that reaction that, that's where I do most of my analysis. It's really easy to just say at 9:30 Eastern, the Dow Jones is down 900 points, and start speculating what that could mean. But I don't want to speculate. I want to actually see what happens. So Friday, yeah, it was a down day. It was very unusual, by the way, because Black Friday tends to be a strong day for stocks. It's usually very light volume. That was not the case on Friday. We saw very heavy volume on Friday for a holiday shortened day. I mean, we were only open 3.5 hours as opposed to the normal 6.5 hours on the stock exchange. And, we still saw volumes in many cases that were actually heavier than most days. So it was definitely not a light volume day. And I saw it more as an opportunity to accumulate some of those stocks in areas of the market that, we find attractive. The other thing I did, and I'll talk about this a little bit too later in the show. And by the way, I still haven't pulled up any of your screen, so I'll get to everything here in a minute. But one of the things I think that's really going to be important is to see which areas of the market benefit, which ones don't, from any further news on this new variant. I think it's the Omicron variant. Omicron, I haven't heard it pronounced, so pardon me if I'm getting the pronunciation wrong. But I think the key is going to be how the market reacts to the news and where the money is going. That was the key back in March 2020. And so that's where I think we need to kind of be focused here as we get more and more information. All right, so let's head over to EarningsBeats. Got a couple of announcements, then we'll get into all the stuff. First, I just want to let everybody know we're running our fall special. It was originally scheduled to expire on Saturday at the close, but we've had a lot of new members who have tried our service here in November, and we had some requests to extend it. And of course, today's Cyber Monday, so why not extend it a couple of days? So that's what we did. So we have run it, or we have extended it through tonight at midnight. So if you are currently a member, if you're, have a trial membership that's going to be coming due soon, and you want to extend your membership, there's not going to be a better time based on the deals that we are offering based on our fall special. So go into this page, you'll see you can extend 1, 2, or 3 years, and you can get a lot of bonus months to drive that monthly cost down. These monthly numbers that you see here are all relative to our normal $147 a month rate. So anybody who's a trial member, anybody who's a monthly member, or anyone that's an annual coming up for renewal, say in the next 6 months, I would seriously consider this offer. But that will be running through the end of today. This is it. There will be no more extensions. It's been going on now for a couple of weeks. So I think there's been plenty of opportunities. If you do want it, this is a great opportunity to extend at probably the lowest cost you're going to see. This is the best deal we've ever offered, as far as I'm concerned. All right. So if you are new to EarningsBeats, if you're not a member, and you're not even a free EB Digest subscriber, I would encourage you to, at minimum, go to our homepage, scroll down, and find our EarningsBeats Digest sign-up form. All it takes is name and email address. No credit card. You can unsubscribe at any time. But this is a newsletter that we publish 3 times a week, Mondays, Wednesdays, Fridays. Normally out by about 8:30. I know it's probably been a little later than that recently, but that's my fault. I've been getting it to Aaron a little later, but I'll try to get it back out sooner so we can have these out earlier for you. But Monday, Wednesday, and Friday is when you get that. And I'm seeing a lot. Is there a problem, Aaron, with my screen?
Yes, your screen wasn't showing. It was showing your background.
Still?
Yes.
All right. Why did
so I shared my screen when you were talking about the special. It wasn't sharing your screen.
Okay, I'm going to try it again. I don't know why it's not sharing. Let's try this. Is this better?
I'm still seeing your background.
What in the heck? I'm doing the same thing I've always done. Sorry about that, everybody. Let me see if I can figure this out on the fly. First it was the allergies, now it's this. This is a bad start to a Monday. Let's try this one.
That works.
Oh, that's weird, because I get options on different things I can share, and I had to pick a different option. Anyway, well, it's working now. So just let me know if there's any issues going forward, and I'll try to right the ship. But sorry about that, everybody. All right. So anyhow, Well, let me just make sure everybody knows this is the fall special that we're talking about. I know you did bring it up, Aaron, but just wanted to point this out to everybody. So if you go over to EarningsBeats, you can click on that and just find out more about the special. It does end today. I just want to stress that. So this is the last chance. And then there was the area I think Aaron was pointing out that I was talking about. So just it's a free newsletter, name, email address, boom, you're in, no cost, no credit card. I think it's a great way to learn a little bit more about how we look at the market. That's really what it's designed to do. It's to try to, to give something back as far as analyzing market, but it's also to share some of our views, the way we look at the market at EarningsBeats, and hopefully to maybe get you a little bit more acclimated to the way that we look at the market. And that's not to say that it's any better than the way you look at it, but maybe you can pick up some pieces, some things that we do. Maybe it's relative strength. That's one of the things we talk about a lot is relative strength. And of course, from our name, EarningsBeats, you can probably assume that we're pretty interested in earnings and companies that beat earnings. So those are just a couple of things, but you definitely want to check that out in order to learn a little bit more about us. All right. So let's go ahead and move on. Let's talk a little bit about Friday because it was a bloodbath. Looking at the screen, I see the Dow Jones, for instance, closing below the 50-day moving average. Now, some will look at that and say, oh my gosh, Armageddon's around the corner. Well, it's certainly not what I would like to see. I'd rather see the Dow and the S&P and the NASDAQ all set new highs. But fact of the matter is that we're going to have pullbacks from time to time. So we have to evaluate these pullbacks. We have to look beneath the surface to see what's being sold. Normally, it's not unusual to see aggressive areas of the market being sold off when the market is selling off, because that's where all the profits are. As far as short term, if the market's been going up and it's been driven by aggressive groups, then when it sells off, it's going to probably sell off in many of those areas. What's more damaging to me is when the stock market's going up and it's not being led by those aggressive areas. Because anytime aggressive areas, and if you're unfamiliar with aggressive areas, I'm talking about technology, consumer discretionary, communication services, even financials and industrials, maybe to a little lesser extent. You're going to see more value-oriented companies scattered in those two sectors. In technology, you're not going to see a whole lot of value stocks. Most of those stocks are going to be growth stocks, growth-oriented. And when investors are pouring their money into those stocks, and that's what's leading the market higher, that's referred to as a risk-on market. That's a market where traders, investors, Wall Street, everyone is willing to take risk. That's good. When you see a market going up and being led by consumer staples and utilities and real estate, that's a market that's going up where investors are not willing to take on that risk. That's a risk-off kind of an advance. That is, it's kind of like looking outside. You see, you have cloudy days and then you have cloudy days, if you know what I mean. I mean, you wake up to some days and it's a little cloudy, but it looks like, maybe the sun's going to break through and it doesn't really look that bad. Other days you wake up and it's like, okay, we're getting a storm. Well, that's kind of the way I'd look at it. That would be the analogy I would use. So when I see the market going down, we're in an uptrend. We're in a secular bull market. It's not going to go up all the time. And a week, maybe a week and a half ago, if you follow my articles and you are a member at EarningsBeats, I was talking about the volatility index rising with the S&P 500. Now, subsequently, you can see sell-offs. And the reason is when the VIX is rising with the S&P 500, which normally doesn't happen. Normally, the S&P 500 goes up, VIX goes down. S&P 500 goes down, VIX goes up. It normally is, the inverse. Well, recently, and it doesn't happen often, but recently the VIX was going up. There was more and more nervousness in the market, even though prices were setting new all-time highs. That just alerts me to the fact, it doesn't mean we're going to come down. It doesn't happen every time, but it alerts me to the fact that the market's growing a little bit more nervous and it may not handle bad news well. Well, I mean, here we are. We had some bad news and the market didn't handle it well. So I would say the signals we were seeing 10 days ago, 7 days ago, whatever it was, they're playing out right now, and they're playing out in the form of what I believe is just a short-term period of selling. Futures this morning are back up again. No real horrible news out about the new COVID-19 variant. And as a result, Dow futures, last time I looked, were up almost 400 points. S&P 50 points, NASDAQ 200 points. Crude oil, which got absolutely clobbered on Friday, energy stocks were hit hard. Crude oil up $4.40 last check, back up 72.5 a barrel. That was down to about $68 a barrel. We were just up, well into the 80s recently. That's a pretty big haircut on energy, but we are seeing a rebound there. So, I think I don't know if we've played out. I don't know if all the selling has played out at this point, I guess is what I'm saying. Because you just don't know what headline you're going to wake up to. I can't possibly know what is going to happen with this COVID-19 variant and, the news that's going to hit. What I can tell you is I don't believe that it changes a thing in the long term. Now, maybe it comes out and it's much more deadly than anything else we've seen, and the vaccines don't work. Then, yeah, are we going to invest based on thinking that the worst possible case is going to happen? I don't think that's a very good strategy, to be honest. I think I would say that the odds are that, yes, it could be another Delta type variant where maybe that's going to be the new strain of this virus that kind of takes over. But to just think all the vaccines are worthless. And, a lot of people who have had COVID-19, are they going to still have antibodies that fight the new infection? I have no idea. Nobody does. But my belief is that we're in a secular bull market. This is a healthcare crisis that we've been going through, as I said a year and a half ago. It's not a financial crisis. And long-term, the bull market remains intact. So if I'm a long-term buy and holder, I am ignoring everything I'm seeing right now. I don't see any reason to panic and get out. What are you going to do if the market goes right back up to a high? Then you got to think about buying back in at higher prices. So long-term, don't get caught up in the news. Stick with your long-term strategy. Short-term, of course, it's a different story. And that's, something that we try to focus on. But anyway, looking at all this, you can see Dow, S&P, NASDAQ, all very, very difficult days. Mid caps, small caps, even worse on a percentage basis. So market got hit, but we're in an uptrend. I am not personally worried about long-term. I think we're going to go back up to new all-time highs, but short-term, flip a coin. I honestly, unless we get more bad news, I think you're going to see buyers jumping right back in. Now, as far as the sectors go, you can see healthcare, all 11 sectors were down on Friday. Healthcare, though, on a relative basis, did the best, lost only 1/3 of 1%. The worst, energy, 4%, financials, 3.3%. These were the two groups hit the hardest. These are also two groups that closed below their 50-day moving average on Friday, but they're also two groups that remain in uptrends along with the overall market. Now, the interesting part was, it was literally, in the words of Yogi Berra, deja vu all over again. Recreational services and airlines, those were the two groups that absolutely got torched back in March 2020. And they were already going down and took another big drop on Friday. Recreational services down more than 10%. This includes, if you looked at the S&P 500 leaderboard or loser board on Friday, you would have seen Royal Caribbean Cruise Lines. You would have seen Norwegian Cruise Lines. You would have seen Carnival Cruise Lines, CCL. All these stocks were littering the top of the leaderboard. There were also airlines on that loser board as well. These were the two groups that got hit the hardest. These were also the same two groups that got hit back in 2020 the hardest. So it kind of like what we saw 20 months ago, revisited. I actually went in and did an analysis last week, and I'll talk about this a little bit more in a couple minutes, but I did analysis where I looked at where we had closed on Wednesday and, how we did on Friday. And then I also looked at where we opened on Friday versus where we closed on Friday. Because as you know, last year, if you were following us, the most important technical indicator throughout that crisis, in my opinion, was the accumulation distribution line, because every stock was going down at the open, but then Wall Street, it was kind of being masked. Some stocks kept going lower, but other stocks would rally back. And the differentiator between the two was the AD line. That's how you could tell which stocks were bouncing back during the day and which stocks kept selling off. And so, of course, we bring up this new variant. That's the first thing I want to look at. I want to look to see what truly was being sold off and being distributed during the day on Friday versus the ones that appeared to be accumulated. And you might be a little surprised at a couple of them, and we'll go over that in just a minute. But anyway, let's keep moving. 10-year Treasury yield today. We do have one key economic report out later this morning at 10 a.m. We're getting the October pending home sales, which is expected to rise 0.7%. Let me give you an update here to show you where the yield is at this moment. Currently, we are up 7 basis points to 1.555%. So we are getting a rebound in the yields, which means Treasury prices are going down. If yields are going up, Treasury prices are going down, means bonds are being sold. That's a defensive area of the market. Investors are selling those right now. So that's giving us a little bit more of this risk on environment. So whatever collectively, Wall Street and everybody looking at the stock market, whatever they saw over the weekend about this COVID-19 variant, they must have felt like it wasn't as bad as what they thought on Friday, because we're getting a rebound in many of these higher risk areas and sell-offs in the lower risk, like the treasuries. Anyway, October pending home sales coming out at 10 a.m. expected a 0.7% rise. I just want to give you this range because honestly, last month in September, this pending home sales was minus 2.3%. And those experts can't quite figure it out because the range on this today, this pending home sales report, there are some that are expecting a minus 1% in pending home sales for October, and others that are expecting a rise of 2.9%. That's the range. So the estimate, the consensus estimate is 0.7%, but there's a very wide range. So that'll be an interesting report to watch at 10 a.m. That'll be out just about 38 minutes or so. As far as the yield goes, I think we're in this range right now, short term. We still could go back down into 130s, but we set this low at about 141, 142. I think maybe that, along with this high of 175, we may stay in this range now for a period of time. Going to be interesting to see what happens to the Treasury yield when we start to get more of the inflation numbers out. And I've told everyone, mark your calendars. That's December 10th and December 14th. I believe the 10th is the CPI and the 14th is the PPI, but it could be the other way around. I'm not sure. But just keep those dates in mind, because if Wall Street, I should say if the media wants to pick up something and run with it, it definitely could be inflation. And we could see another big inflationary report. And if we do, that's going to make it very difficult for the S&P 500 to set new highs in the near term. I still believe we're going to be at another all-time high sometime between now and the end of the year. We only have 4 or 5 weeks, 5 weeks left. But I do expect that we're not done going higher. All right, moving on. Just wanted to take a look at some of the damage here. So when we look at the Dow Jones, here's your move down through the 50-day moving average. Now, in an uptrend, and this is the daily chart. Really, if you want to look at the big picture uptrend, you want to go to a weekly chart. But just on a daily chart, looking at the higher highs, higher lows, here's your double bottom lows, kind of same over here. So really almost like a triple bottom, just below 34,000. From there, we went back up and set a new high. So I'm not going to be at all concerned in the intermediate term, as long as long term, I'm not concerned at all. Intermediate term and short term, I think you have to be a little bit concerned just because, we're in the midst of this uptrend, but overall, we are in the midst of a short-term downtrend. And so where does it end? Well, as long as it ends at this level or above, I'm feeling fine with the intermediate term. And even if we break below long term, I'm not really concerned. Why? Because when I go to the weekly chart, what I'm seeing is weakening PPO with higher prices. So we already know that there's a little bit of slowing momentum. And I think some folks look at this wrong. When you're looking at this and you see that PPO line below the other line, which is the trigger line, anytime you're below that line, there's some that look at that as negative. I don't. I look at whether or not the PPO is above zero or below zero. That's the main thing I look at from a intermediate term basis. If this weekly PPO is above zero, I have no issues whatsoever. Now, could we have short-term weakness? Yeah, there's a negative divergence. We could, pull back to 34,000 again. If we do that, we're going to get a 50-week SMA test. And if you look back, with the exception of this trade war drop and the pandemic drop, those 50-week tests, and I'll go back even further, but 50-week tests tend to be really good areas to buy into a secular bull market. I mean, now look at this, the last 10 years. We don't trade much below the 50-week moving average. We don't trade below the center line on the PPO very often, weekly PPO. So I would be thinking to use this weakness as an opportunity. But how much weaker is it going to be in the short term? Well, give me the headlines for COVID and I'll tell you. It's so impossible. I mean, if something comes out tomorrow morning that a scientist has discovered that the vaccine, or Moderna comes out and says something about they think the vaccine is still highly effective against this variant, we'll see futures up 500-600 on the Dow. I believe, maybe more than that. So give me the news and I can tell you. Without the news, I have no idea. But what I would be watching for short term is, does the 34,000 area hold? If it does, I'm not concerned at all. All right, moving on, I wanted to show you, this is the article I wrote talking about Friday selling and comparing it to March of 2020. And if you didn't read this article, I would suggest you do so. I mean, I think it's a lot of really good information. But when I went back and I looked at the ranks of the NASDAQ, of all the major indices and all the sectors, I ranked them based on their March performance 2020. So this would have been February 19th, March 23rd. This is how they were ranked. Those are the prices. And then on Black Friday, I just put the percentages in and ranked them. Shockingly, the rankings were almost the same. There was very little that was much different in terms of performance. So that was one takeaway. Then you got to look at the outliers. Which ones were the best in 2020, March 2020, and also strong on a relative basis on Friday? Here they are: gold mining, mobile telecom, biotechs, and toys. And then you got the flip side. Which ones were really poor, did horribly, both in March of 2020 and on Black Friday? Well, recreational services, oil equipment services, coal, airlines, aerospace. Those were consistently the 5 losers. So if you keep hearing about COVID and there's more and more fear out there, these are probably going to be 5 of the areas you want to focus on the long side, if any. And these are the ones you want to be really careful with. And then I looked at the AD lines to see what's going on. One thing you probably noticed, or maybe you noticed, well, certainly you noticed if you read my article, but energy, even though it had a horrible day, it was down 4%. It finished on the high. So that is actually a positive for the AD line. And the XLE, even though it's been having all this weakness, is literally on the verge of a 3-month breakout in its AD line. So on the surface, you might think, energy is horrible. And I just said it was bad right here. Oil equipment services, you go up here, energy, worst performer, both March 2020. But I'm just saying things are a little bit different here, because in March 2020, the AD line wasn't going up. In March 2020, I don't have it on here, I'd have to go back further, but the AD line was getting crushed on energy. So that is one difference that I saw on Friday, something to think about. Anyway, just wanted to point that out. Make sure you know that that article is over there. Go out and check that out. Got one earnings report and then the three you must see, and then we'll get into the, well, then markets actually just did open. So I'll try to wrap this up quickly. Lee Auto, give you an update here. You can see the stock after posting better than expected earnings, stock up almost 8% today. So breaking out above that October high, I think that's good news. Still got to clear, I think, $36. And we got some other highs over here, but I think 36 after going straight up for almost 2 months, that's where we kind of topped out, couldn't get through in August. That's probably going to be a short-term issue. Eventually, I do see this going higher because I like the auto group. I'll just tell you some other companies that will be reporting later this week. Tomorrow, we're getting Salesforce.com, Network Appliance, Zscaler, ZS. That's one you might want to keep an eye on. Wednesday, Snowflake, and some of the, you might recognize some of these software stocks, CrowdStrike, Viva, VEV, Okta, OKTA, Splunk, SPLK. All of those stocks will be reporting on Wednesday. Thursday, we got DocuSign coming out. Another big one there. Alta will be reporting on Thursday. And then not a whole lot coming out on Friday. Bank of Montreal, BMO, will be out on Friday. But anyway, still a number of earnings coming out. Earnings season has slowed down almost to crawl, but we still do need to kind of watch for the companies that are reporting later in the period. All right, last thing I wanted to do was just go over the three you must see. And I was just going to pick up 3 stocks. Now that the market's open, probably would be a better time to look at these 3. These were 3 stocks that got hammered during COVID-19 and, you know, the pandemic. And with the news on Friday, took another big hit. American Express. Now, American Express, look, it already closed below the August-September low. And I really thought American Express was, you know, starting to turn it around, but doesn't appear so. And its AD line back down closer to a 52-week low. It's up today. I don't know. This is a really tough call because I do feel like I would say if it goes back down below the low on Friday, I would be out of AXP. I mean, I think you just got to hope that, you know, folks were accumulating it at the low. We did bounce back off that low at the end of the day. We've gapped up today. I don't want to go back down below that low. Another one, Boeing. I actually had Boeing for a little while, owned it, lost a little bit of money in it. But when it was moving up here, I thought, okay, we're trending above the moving averages. We're taking out the last high. Things are looking good. That's exactly when Boeing fell apart. But it did print a nice hammer. So unlike AXP, Boeing came back up and closed at a high after testing a 52-week low from back in January. So nice reversal on Boeing. Maybe that will hold. Definitely 193 on a closing basis. I would be very careful if Boeing doesn't hold that. And then the last one, RCL. This is Royal Caribbean Cruise Lines. Big move down. You can see we got some lows that we need to be watching. 64, 65, up to maybe 67. I think that's going to be the key area for the stock if it does fall further. But this was $97.50 3 weeks ago and went to 67.5. It lost almost 1/3 or roughly 1/3 of its market cap in 3 weeks, and topped off, of course, by Friday's news on the new COVID variant. But these are the stocks obviously are going to get hit by any bad news relating to COVID. All right, that's it. Let's just quickly see what the market's doing. Sorry, I ran a couple minutes over. Part of it was the allergy got me going so late and not being able to share my screen. Really apologize for those issues this morning. Sorry. Yeah, right now we got the Dow up almost 300 points, NASDAQ up over 200. So on a relative basis, you can see the money going back into the NASDAQ. Small caps, mid caps, both up % or more. Also notice the VIX. You know, when the VIX gets up into that 28 to 30 area, sometimes that tops. Well, we were at 28.62 on the close on Friday. Today, we're down almost 15% on the VIX. So unless more bad news comes out, you know, the market has a way of figuring out how to deal with things. So now that the news is out, if we can rebound, I think maybe the worst is behind us. I'm just going to say maybe, because who knows what news is going to come out tomorrow. I mean, we just can't be sure. But market, I thought, handled the news Friday pretty well, rebounding. and not really losing much ground after the open. I thought that was important. We'll see what happens, as we go forward. But we do have jobs report coming out later this week. We've got the big inflation reports coming out the 10th and the 14th. So we got some things going on. I will tell you that once you get past the 15th of the month, and especially the 20th of the month of December, the stock market loves the 20th through the 31st. Everybody's got a different definition for the Santa Claus rally. But for me, historically, because of all the work I've done, I find the 20th through the 31st tends to be very, very solid for US equities. So keep all that in mind. I'm going to wrap up. Appreciate your patience earlier. One last reminder that we do have that fall special going, and it ends at midnight tonight. So if you are thinking about either joining our service or you're thinking about extending, today is the best day to do it. Listen, everybody have a great day. Be back tomorrow over at Stock Charts TV. You can see that simply by going over at 9 a.m. on Tuesday morning, clicking on that Stock Charts TV, and you'll be able to watch the show. Everybody have a great day. Happy trading.